How confident are you as to what is going to happen in the residential market? Stay tuned. Hello, everyone, and thank you for joining today's edition of NoteSchool TV. It's episode number 222. Thanks for being here. Before we get started and bring on our guest today, I want to just three housekeeping items. Number one, make sure and like the presentation today. Share it with your friends and associates. And then number two, if you haven't already subscribed to NoteSchool TV channel, make sure and do that. And also hit that bell notification so that you will know when we go live every Wednesday. With that, and if you want to know more about what we do at NoteSchool, simply go to noteschool.com/TV. Again, noteschool.com/TV. With that, I want to bring on, founder of NoteSchool, chief visionary officer, the guy that's always looking out over the horizon, and all-around good guy, Mr. Eddie Speed.
Good morning.
Good morning. How are you?
Well, we have a super special guest this week, very special. And I think all of us are very curious about what has happened in these residential trends. We've had this really wild roller coaster over the last few years. And now some things are kind of parked in the marketplace. And whenever we're in doubt, we bring the ultimate market expert on to tell us about it. And so that is today. And so I'm very, very excited, Joe. And we will, let's rock this house. Let me get started with him.
Let's do it, Eddie. I'm going to jump off. You guys, can't wait to hear. I'll see you guys at the end of the show.
All right. Our guest today is an absolute expert in the field of residential market and trends. He is vice president of market economics for auction.com. Darren Bloomquist's role there is to analyze and forecast very complex macro and microeconomic trends in the market, and then provide those as a benefit to both buyers and sellers on the auction.com platform. Darren's reports have been cited by literally thousands of market outlets, including the Wall Street Journal, the New York Times, and USA Today. He's also been quoted in hundreds of publications and national news broadcast networks, including CBS, ABC, CNN, CNBC, Fox Business, and Bloomberg. He is the man that we look to give us the information about what's happening in residential real estate. You guys welcome my friend, Mr. Darren Bloomquist.
Thank you, Eddie. That introduction was amazing. Hopefully it didn't overhype me, but it's so good to be here.
It's the truth, and we know it. You're just modest, but we appreciate it. We are so grateful you're here today. I would say that I'm on several, of these Facebook private groups, and everybody's saying what's happening in the market and stuff. And I reached out to Joe and I said, Joe, I don't want to get the hot sports opinion on Facebook about what's going to happen in the market. I want to call the guy that really knows, and that's you. And so you're here today to help give us some vision and make some decisions about what we're going to look at and analyze and be optimistic about and concerned about into this market in 2025. So thank you so much for doing this.
Well, you're most welcome. It's always great to be with you. And I always learn a lot just talking to you and hearing about what you're seeing, because there's always different perspectives out there, but you're on the front lines. I also would say that I look at a lot of data, but to be honest, when it comes down to the most reliable thing that I'm looking at these days is what our buyers on auction.com, how they're behaving and what they're telling us, because they're on the front lines of hundreds of housing markets across the country. And so their confidence in those local real estate markets tells me a lot about how to interpret the macro data I'm looking at. So anyway, that's just kind of a theme you'll probably hear from me today, is relying on the data, yes, but also the experience of these, we call them local community developers. If you go to any market in the country, if you go to, Jackson, Mississippi or Dayton, Ohio, these are the folks who know the most about that local real estate market. They're buying probably dozens or maybe possibly hundreds of properties a year, and either renovating, flipping those properties. So they're or building new homes. So they're the folks. Those are the type of folks buying on auction.com, and their bidding behavior tells us a lot about what's going on in the market, and we do surveys of them as well to get to hear what they're saying about the market. So I'll share some of that. But anyway, that's become more and more of my go-to in terms of looking at what's going to happen going forward.
Well, the good thing, Darren, that I tell people all the time, I'm out of the office today. I'm at an event, I'm with a group of very sophisticated real estate investors, many of which I'm sure you know. And everybody's trying to guess this market right now. We have listings that are up. We have home builders that seem to have a lot of inventory that's not moving the way they thought. And everybody's like, I announced to them yesterday. I said, look, we're interviewing Darren Bloomquist tomorrow. We're going to find out what the data is telling us, not what we hope, not what we're gut feel, but what the data is telling us. And for a guy that's been in this for 4.5 decades like me, I'm so glad that I can make data-driven decisions now instead of just guessing. And so
there's a lot of good data out there. So
it's great.
Happy to oblige on that.
You're awesome. We are very excited to see what you've got today. So let's roll it.
All right. So now, our focus at auction.com is the distressed market. So I'll kind of start there as a launching off point, but then, we can go from there, and got to figure out how to advance my slides. But so here's the distressed marketplace. And I think this is how we look at the world. But this tells us a lot about the overall real estate market. And a lot of folks thought coming out of the pandemic that we'd see a big wave of distress happen. And we really haven't seen that, at least at the level that we look at it. And so, but we are seeing signs that's shifting. So I'll get into that. And the gray bars here are what was going on back in the first quarter of 2020, just as a benchmark. And the green are what's happening now, the latest data as of the third quarter of 24. This data is a little bit delayed, but what you can see is that if you look at this as a funnel, the top of the distress funnel, actually we're at or above what we were back in the first quarter of 2020. So there's approximately 2.2 million delinquent loans nationwide. Of those, 870,000 almost are seriously delinquent, meaning 90 days or more delinquent. So those two have, and if we looked at this even a quarter ago, that seriously delinquent number would have been like 100,000 lower.
Yeah.
So we have seen a significant shift just in the last quarter, where that SDQ number has come up and is now at or even slightly above the pre-pandemic number. So that's important. But then if you look at the bottom of the funnel, where how many of those SDQs are converting to foreclosures, we're still at basically 33% below Q1 2020 levels. And then foreclosures brought to auction, the ones that actually go to the auction and sell, which is what we do at auction.com, or at least part of what we do. Those are at only 35% of pre-pandemic levels. So in other words, they're 65% below pre-pandemic levels. So we haven't seen distress come back, and that's a reflection, I think, of the strength, some of the underlying strength of the overall real estate market. But that, I've heard it said, an overused strength becomes a weakness, and I think that's kind of where maybe we are in the retail market, is this undersupply, structural undersupply that we've had of homes is a strength that's keeping the market from seeing a lot of distress. It's created this unprecedented rise in home values and home prices over the last 5 years. And it's also which in turn has prevented a lot of distress in the market. But of course, that strength is becoming a weakness, I think, in the fact that we have seen home values go up so much, it's become unaffordable. And that's where we're starting to see some of the cracks with the inventory that you're talking about, the inventory rising, and our buyers are becoming concerned with that too. We see a pretty strong correlation in the sales rate on our platform, the percentage of properties that sell, and inventory in the local market. So those markets where we start to see retail inventory jumping, a lot of the Southeast markets, and some other areas as well, some parts of the West, that's where we see our buyers pulling back and getting a little bit less confident that the 2025 market is going to be as good as it has been over the last few years. And even in the second half of 2024, we saw them pulling back.
So Darren, I was doing a presentation yesterday to this mastermind group of real estate investors, and I was talking about the non-performing market. And I said yesterday, and I want to make sure this is correct, and please correct me if I didn't say it correctly, but what I really said was, we have 1 million loans in no man's land. We have about 2 million loans that are delinquent. I know 2.2 is what you're saying here. So say we have 1 million loans that are not seriously delinquent. They're 120 days or less. So they're not subject to being foreclosed. Then we have 250,000 loans that are in foreclosure, right? Well, the problem is that leaves us 1 million loans in no man's land, right? They're seriously delinquent, but yet they're not in foreclosure. What are they?
That's right. I think they're in this, we call it the spin cycle, loss mitigation spin cycle, the big shift. So, I did say a lot of the reason that we're not seeing as much distress as maybe some people anticipated, or not even as much as distress as 2019, which 2019 was a relatively low year in terms of foreclosures. But there were 210,000 foreclosures in 2019, completed foreclosures. We're now running at, and I'm kind of stealing my own thunder here, but we're running more like at 75,000 completed foreclosures. Part of that is the strength of the market that I talked about. But part of it
the delinquent loans are getting paid off.
What's that?
Delinquent loans are getting paid off.
Yeah, and people have equity to work with. But I think under what you're talking about is this shift that we saw during the pandemic in loss mitigation. So when a mortgage servicer, a loan goes delinquent, it doesn't go through that typical, 90 days, then it gets referred to foreclosure that it used to. It goes in first to forbearance, which lasts a minimum of 3 months. And then it goes into loss mitigation waterfall, where they throw everything in the kitchen sink at that loan to try to get it to perform before they refer it to foreclosure. And that's where these million loans that you're talking, or many of these million loans that you're talking about, are caught up in this loss mitigation cycle. And the concern there is, and I think I have some slides on this, but what's happening during that loss mitigation cycle is it's really the loss mitigation solutions that have come out are actually eroding the equity in these homes over time. So the longer they kind of stay in that loop, equity is being sucked out of the home.
Yes.
And at some point, and unfortunately, many of these folks, they don't have a short-term problem. The forbearance, that's designed to solve a short-term problem.
Yes.
But for the folks who have a long-term problem, it's just unfortunately delaying the inevitable. And so it's delaying the inevitable. And meanwhile, equity is being pulled out of their home.
Right.
And when those and we are seeing more of these fail. And I think we're going to start to see an uptick. I don't think it's actually going to come probably until the end of 2025. But because of all the delays built into the system, but this rise in delinquencies, they're seriously delinquent. loans that I mentioned here, and it's actually a little bit more evident on this slide. This is MBA data. On the right-hand side, this shows we've had 13 consecutive quarters of year-over-year declines in SDQ rates, but in the third quarter of 2024, they rose for the first time. And that to me is a shift that some of this distress that's in this loss mitigation cycle is moving down the funnel, but it's going to take it a little bit longer and to move down the funnel. Now, to your point, some of it may never get to foreclosure because you actually see FHA. I don't know if your listeners pay attention to this kind of thing, but they actually maybe kind of quietly, it wasn't necessarily intentionally quiet, but they did put into place a permanent mechanism for selling off distressed non-performing loans.
Yep.
Which they haven't really sold a lot of non-performing loans over the last few years, but there's some signs that they're gearing up to do so. And I think they're seeing that some of this distress that's been in the loop, the doom loop of loss mitigation, is coming out, and they're going to have to figure out some kind of final solution, whether that's foreclosure or a loan sale.
Any thought as to whether a new administration accelerates this? For me, as a guy that's just been in the industry a long time, right? 1 million loans that are between not seriously delinquent and the average delinquency of loans in foreclosure, what is it, 1,300 days? It's some wild number that
I was just looking at this at FHA. They say it's an average of 16 months between delinquency and going to foreclosure auction. So yeah.
So a new administration, do they accelerate some of that?
And I apologize for flipping around here a little bit, but I did want to get to something that maybe speaks to that. Just some bullet points I have. I do think there is a shift with the new administration. It's hard to say until they actually get people in some of these positions as to how much a shift it will be, because those people will drive the policies.
Yes.
I would say philosophically, preventing foreclosure is a pretty bipartisan issue. So it's not like all of a sudden there's going to be like, yeah, let's foreclose on everybody we can with the new administrations. But I do think that there is a realization with the new administration, at least what I've heard, that first of all, toward deregulation, and that affects the Consumer Financial Protection Bureau and some of their regulation over mortgage servicing.
Yep.
But then also more of a realization that a healthy housing market depends on foreclosures to be the kind of a natural consequence of that life cycle, and not necessarily preventing foreclosures at all costs. So I think we will. So the first piece on the regulation, Consumer Financial Protection Bureau, they have been very aggressive in, and mortgage servicers, I think, are somewhat afraid of them, and in terms of moving forward. And I think there probably will be a shift there. It will be very interesting to see who gets put in as the CFPB director, and what their stance is. But there's the CFPB is just recently has this Reg X proposal, which basically shifts the loss mitigation process, but tries to institute a lot of the learnings from the pandemic in there. But it does, they have this loss mitigation review cycle. I think they realize, based on feedback from the servicers, that needs to be more clear on how that's triggered. They've talked about, right now they're saying there's a loss mitigation evaluation period that's 90 days, shortening that to 30 days. And so it'll be interesting. If this went in as it stands, as it's been proposed, I would think it actually would keep things as they are and keep a very lengthy foreclosure process. If the new director comes in and completely scraps this or modifies it, we could see that distressed life cycle shorten. And then the second big thing that we look at from administration coming in is FHA policy and FHFA as well. But FHA specifically has proposed a new loss mitigation, basically making a permanent loss mitigation waterfall using a lot of the principles from the COVID loss mitigation waterfall.
Yeah.
But there's the second bullet point here, the guardrails that they're putting in, I think tips that and this is from the previous, the current administration, it tips their hand that they realize that there needs to be some kind of end to this cycle of folks just sitting around in loss mitigation it feels like indefinitely. So they put in a 3-month trial plan. So folks have to actually prove that they can make their payments before they go into a permanent loan modification or something like that to keep the home. And then it limits the borrower to one home retention option within an 18-month period. So they can't just continuously cycle in and out of loss mitigation. They can only basically get one lifeline every 18 months, which I think will kind of, winnow some of these million delinquencies that you're talking about and figure out which one of those are actually good candidates for permanent home retention and which are just, unfortunately, the homeowners are in a situation where they have a long-term problem that's not going to be solved with a short-term solution. So anyway, hopefully I'm not answering too much on that, but I think there will be a shift. And we'll see once the FHA commissioner, that's an important post to be looking at. It has not, there's not been an appointee yet for that. And then the CFPB director, which also has not been appointed yet.
Well, it is going to be very interesting times. And I agree. You're the expert on it and very connected to the people that are currently, reading these trends. But I've got to believe that, as a business guy, a million loans that are just in limbo that doesn't seem to be helping who they were intended to help, extending it, as you said, to somebody that can't fix their problem. I'm not sure that's kind, but because, as you said, the legal balance keeps growing, right? All the accruals that it takes to pay off the loan just keep adding to what it would take that erodes their equity. So yeah. I'm as a longtime business guy in this space, I hope that we have a correction there.
Yeah, I think the pendulum will swing. The question is how far it will swing back toward a little bit more efficient process of dealing with these distressed loans, and it's still in a compassionate way, of course, but sure. Not actually. A lot of this loss mitigation is just stripping equity from these homeowners, and they could have walked away with more equity. The big question is, where do they go? But still, at some point, I think they're better off if they walk away with that equity and get a fresh start rather than kind of just continuing to sit in limbo.
Yeah.
And this chart is illustrating that, by the way, with the average time that we do see properties get scheduled for auction and then rescheduled. Back in 2019, when that happened, the average time between when a property was first scheduled for auction and then the most recent auction was 188 days. That's now gone up. Actually, in 2023, it's 479 days. I don't have it on the chart here, but in 2024, it's gone up to over 500 days. That these homes are this is even after they've been scheduled for auction. They'll get scheduled and rescheduled multiple times. And on average, they're sitting in there 500 days. That's not even including all the time that they were sitting delinquent before they entered foreclosure. And during those 500 days, they're losing equity, which is the right-hand chart. They're going from $150,000 to $140,000 in equity, and that's just equity on paper. When they sell at the auction,
Right.
A lot of times we're discovering based on the condition of the house, they don't have anywhere near the equity that it may have looked like they had on paper.
Yeah, and not only that, and not taking away from, a concern over the delinquent borrower, but also run the mortgage business. Like, you went from 188 days to get to foreclosure to 500 days. Like, that doesn't seem logical to me.
Yeah. Yep. And it puts the mortgage servicers in a tough position. So yeah, I do think it actually will be healthy to see a shift there. And we'll actually see that provide some more inventory in the market as well that can be repurposed, renovated, and all that.
Got it. Great data. Excellent.
So what do you want to talk about next? More broad-based.
I think here is my concerns. My concerns that we've been watching all year, and once again, we call you because we consider you the ultimate expert. But our concerns is we've been watching this year-over-year listings increase. We've been watching the home builder situation, which doesn't seem to be very stable, right? And all of this kind of leads to more inventory for sale and seemingly longer days on the market. And obviously the builder trend and what they're selling houses for is it's not flat, it's going down. That's what, at a national level, that seems to be what we're observing. And that's why we called you in, because are we thinking straight? Or are we, what level of concern do we have, and where do you see the market?
Yeah, I see it. I actually think the market is due for correction. First of all, I would say. Now, what is going to be the trigger for that correction? It's hard to say. And this is some data that shows why I think the market's due for a correction. Is basically if you look at price to income ratios going back in time. And if you base house prices on the average historically normal price to income ratio, we're at 25.5% above what we quote unquote should be with a normal price to income ratio. And that's, if you look back at the beginning of the far left of this chart in 2006, we weren't even that, we were more like 20% above historic price to income ratios. So we were in a bubble then, and we all know that bubble burst. We're in a bubble now. It doesn't now. I think because of some of the different underlying structural pieces of the economy and the housing market, we're in a bubble. It's not as prone to popping, but at some point, I believe that will revert to the mean. I think the most likely way it will revert to the mean is more of a slowdown in home price appreciation. And I think inventory is maybe the first domino to fall there. If we can continue to see that inventory rise, like we have in some markets, and that's what this heat map up on the left shows you. This is Realtor.com data. The yellow it shows where inventory is actually rising in almost every market, but it's rising much more in Florida. You see a big cluster, and parts of Texas, other parts of the Southeast, the West, Colorado, Phoenix, parts of especially Southern California. Anyway, that inventory I think is one of the first dominoes to fall that will say, okay, putting more pressure on home prices. And I think the home builder market operates a little bit more quickly than the existing home market, because home builders are operating just more as a business than a regular homeowner selling a home. And so they're willing to capitulate on price faster. To answer your question, I do think in 2025 and by the end of the year, there'll be a lot of pressure on home prices, and we'll see more markets going negative in terms of home prices. And when I look, this heat map on the right is just a small piece of some of the data I look at from our buyers who are out there. But the blue there is where the demand is pulling back, and they're saying we're not as confident in this market, that this market is going to continue to appreciate. And so they're buying less and buying at lower price points on our platform.
Mm-hmm.
What they're willing to buy relative to after repair value is going down. And so you see that in Florida, other parts of the Gulf Coast. And at a national level, we saw that what our buyers are willing to pay starting in about May of 2024, we're seeing a downward trend all the way through November. Now, there was a little uptick in December, and I don't know if that's because of the election or if it's because of or it's indicative of a long-term trend. But except with the exception of December, our buyers nationwide have become less confident in what they're willing to buy properties for, if that makes sense. So that actually indicates that they anticipate home price appreciation in 2025, at the very least slowing down, if not going negative.
Yeah, I think that every realtor I know, and I don't know every realtor in every part of the country. So some states that be more liberal oriented may not say this at all, but I know in the part of the world I live in, every realtor I know said things really popped after the election, and they got deals under contract and they saw deals close. So I think the election did have an influence in pushing people forward and making some decisions. So I'm not surprised to hear you say that. That's an interesting point. So
yeah, that we did see that pop. The longer term trend, though, if you look at it, is that our buyers are buying at a lower price point relative to after repair value. It's more like 53% of after repair value, whereas back before mortgage rates started going up, they were willing to pay close to 60% of after repair value. And there's been some ups and downs since over the last couple of years, but it's ended up around that 52, 53%. Indicates to me they just don't think we're not going to see double-digit appreciation for sure. And when we survey them, an increasing number are saying they're expecting a home price correction in their markets. Now, I think the benefit there is if we do see home prices slow down, that could boost, as sellers basically get more realistic about the actual price of their homes, that could boost sales volume in 2025. And that could help in terms of actually getting some of this logjam of properties moving in the market in 2025. But certainly doesn't look like we're going to get a lot of relief from mortgage rates at this point.
Right.
But
I was going to go back and ask you something, Darren,
yeah,
about listings. And I've read information, and not your information. So this may not line up with how you're seeing the numbers, but I've heard numbers along the lines, there's about 25% increase in listings year over year. Is that kind of how you see it?
That's actually that's what I'm seeing. I think the number I looked at for December from the realtor.com data was about 22%. Okay. We hit, and this is nationwide. In some of these markets here that you're seeing in Florida, you're getting into like 40, 50% increases in inventory. And it's been going on for some time. Yes. Nationwide, we hit a 4-year high in inventory. I believe it was in September The numbers come down a little bit over the last 2 months, but it's still up on a year-over-year basis in that 20 to 25% range that you're talking about. And that's nationwide. So some of these markets are much more than that. And, that again, that's a lot of times the first domino to fall. And then the longer those homes sit on the market, the more pressure there is on the buyers or the sellers, to lower their prices.
Any feel about, with that level of increase in year over year listings, what that does to days on the market?
Yeah, we're seeing, and I have that data too. It's not on these slides, but we're seeing the days on market go up. I believe it's on average, according to Realtor.com, about 70 days, which, to put it in context, 70 days is not long. So we're seeing these increases in inventory and days on market. I think it's up from maybe, and this is me just remembering, maybe like 55 to 60 a year ago. So it's coming up. It's not at a huge red flag level yet, but it's moving in that direction, and it will put more pressure on sellers to say, well, especially if they're sellers who have to sell. And we're because of those rising delinquencies that we talked about, there are more folks in that bucket who are much more motivated to sell, because if they don't, then they could lose the home through foreclosure.
Excellent.
Some other, there's a lot in here. Bankruptcy filings are going up. We're seeing a lot more delinquencies come from recent vintage loans that were originated in 2020 to 2024. This is the right-hand side is MBA data. If you look at FHA loans, 44% of their seriously delinquent loans right now are from 20 to 24 vintages. 58% of VA loans that are seriously delinquent are for 20 to 2024 vintages. And the reason, I think one of the reasons that's important is that those buyers are less likely to have built up a lot of equity. Mm-hmm. So there's less of a cushion for them. Another thing I look at is the debt to income ratios. Those are at record highs, except for GSE loans. GSE loans are not quite at record highs. But if we look at FHA and VA, USDA, jumbo loans, and overall, this is data from FHFA, we're seeing, overall, all loans are at, the average debt to income ratio is 41.4%, which is higher than it was even back in, again, going back to the bubble of 2006. So that's a concern that these recent loans have these high debt to income ratios, and they're going delinquent. A lot of them, or they have higher delinquency rates than what we've seen in quite a few years in vintages. So that's another warning sign out there, threat to the market.
I would presume that your feeling is that people's disposable income at the end of the day, I mean, everything costs more, groceries and gas and clothes and you name it. And then all of a sudden they're at record highs in their debt to income ratio on their house. Their disposable income has got to have really evaporated drastically to where it would have been.
Yeah, absolutely. Yeah, the inflation across the board is, and actually this, let's see if I can find, sorry, I'm flipping back and forth a lot, but this speaks to that. If you look at the reasons for delinquencies from FHA on the left and FHFA on the right, it's shifting more. There's an 86% increase in people who are delinquent because they're unemployed. There's a 27% increase in people who are delinquent because of this is excessive obligations. Yeah. Which speaks to what you're talking about. The inflation means that they just don't have as much, their dollar isn't going as far, and so they don't have as much to to spend on, or left over for their mortgage. And you see a similar trend with the FHFA data that excessive obligations has gone from 12% of seriously delinquent to 17%. So that is speaking to that. I think the other thing that speaks to that is the cost of home ownership when it comes to property taxes and homeowners insurance.
Yes.
That's in part caused by inflation and in part caused by some of the natural disasters we've seen when it comes to property insurance. So if you look at the average property insurance payment, and this is according to ICE, is up 52% since 2019. And so your mortgage payment may be fixed, but your property insurance payment is not fixed. It's gone up 52%, whereas principal mortgage payments have just gone up 17% during that same time. Taxes have gone up 18%. So this is putting more pressure on those homeowners as well.
Wow, that's good information right there.
Yeah, and I think I'm probably sounding very pessimistic, and I do think there's a lot of warning signs out there, but I would say that we're still thinking that, I think I said this near the beginning, is that we won't see a huge jump in foreclosures this year in 2025. We're expecting them to be flat to actually potentially slightly down, unless given different scenarios of home prices. But we'll start to see some of these risks materialize, I think, in late 25 into 26 in terms of more, at least in foreclosures. I think if you're looking earlier up the funnel in distress at non-performing loans, those delinquencies, that delinquency bucket seems to have turned a corner, and especially the seriously delinquent bucket, and is rising. So we could see that pool continue to rise in 25.
Darren, I've said in many presentations that this, the builder increase, right? The builders are, I'm reading things of how much money builders spent in buyer incentives just to get the houses moved, like shocking numbers, like Lennar, almost $50,000 a house, right? And then, so you're reading the kind of the builder side, you're looking at the consumer side, that houses aren't getting sold. And is this a reflection of inflation trumps supply and demand?
Yes. Yeah. I think the short answer is yes. At some point, the way, if you look at a supply and demand curve, it's really about, are there enough people who are willing to pay those prices to buy that supply? And the higher you go up that that curve, where prices are higher, the fewer people there are willing and able to pay those prices. Yeah. And so even though you may have a lot of people who want to buy a home and who are in a life position and a demographic position where they want to buy a home, at a certain point, if prices are too high, it limits the number of those people who actually can buy a home. And so, yeah, it's inflation, and specifically, which again, it's like, I think it's a strength. It's become a weakness. Like the reason we saw home prices go up 50% between 2020 and 2022 or 23 maybe is because there was this limited supply. And so sellers had the advantage. They could jack up prices. But that same lack of supply has caused prices to go up so high, in addition to the inflation issue, which is causing costs of supply, of building materials to go up as well, that you've priced out so much. You're starting to price out so much demand in the market that can't afford that supply that's there.
What are home builders going to do?
I mean, I think they've started, home builders behave more rationally than, I actually look at that market as a little more, a leading indicator like you are of maybe the larger retail market, because they do behave more rationally. They're going to say, hey, look, if we can't sell a property at this price, we still have to get it sold. And they're going to rely on those concessions, those mortgage buy downs. And, potentially maybe the last tool in their shed is to actually lower the prices. But yeah, they're going to respond ultimately by lowering prices so that you move that supply curve back into more equilibrium with the demand curve and get properties sold. Now, of course, I think you'll see them in response pull back on new building, and we've started to see that a little bit, although that's fairly strong still. But especially in multifamily, you've seen the pullback in new construction, new permits. So I think that's what you'll see builders do. They may, I don't think we're at a point of fire sale or anything like that, but maybe in some communities, in some areas, that may be, it may get a little bit more aggressive in terms of those price cuts.
Care to do a dart throw on what percentage of home builders cut back this year?
No, I couldn't even. I couldn't venture a guess on that. Sorry, but I'd like to hear what I'm guessing you have an answer to that if you ask the question.
I don't know. I mean, as you said, home builders are running a business model, and if they're biting into the cost, the sale price of their house, 12-15%, and then buyer incentives, which in some cases it sounds like that's true, not in every case, but in other words, I'm thinking like they're going to say, look, we're not making the margin we need to make. We just got to go, we got to go pull back. I mean, that's what business owners do, right? Mm-hmm. And as you said, they make more professional, unemotional decisions than consumers selling their personal home. So I'm just trying to think like, okay, if I'm in the home building business, and I'm not, it looks like to me that they're probably in the drawing board right now trying to figure out like what's an appropriate line to keep adding to the market.
Yeah, and I think I mean, you see them building. One of the things they've done is started to build smaller homes. And then of course it'll vary by area. I think they'll pull back much more in the Southeast. They may actually go. What's interesting, the market has flipped from 5 years ago. It was always the Sun Belt that was the golden boy market of of the U.S. because there are so many people moving there. Of course, I mean, it makes sense. The demographics were in the favor of the Sun Belt. What's interesting is the markets that are now stronger are in the Midwest and Northeast, upper Midwest, Northeast, kind of Rust Belt, so I think you may see home builders think about moving into there. I mean, it'd be interesting to see what's interesting about those markets is there's more inventory, but more distressed inventory, not necessarily in the sense of financial distress, but in terms of condition of properties. And I would wonder, this is total speculation, but if home builders would ever consider getting into the business of going in and if it would be actually more economical to renovate some of those older homes than build new ones.
Interesting. What else, Darren? This is great information.
Yeah, I think we've talked about a lot of the delinquency, emerging risks to watch. I mean, I've alluded to this a couple of times, but I'll get into our forecast for foreclosures for 2025, which is good. And just to put it in context, we're looking at completed foreclosure auctions, properties that go to the trustee sale or sheriff sale and either sell to a third party or go back to the lender. historically, if you look back at the high water mark in 2010, just to put this in context again, over 1 million. It drifted down from there as we dealt with all of the distress left over from the 2008 crisis. In 2019, we were just over 200,000 of those completed foreclosure auctions. Pandemic hit. Low water mark was 2021 when there was a foreclosure moratorium in place. We hit 64,000. It has come up a little bit from that after the foreclosure moratorium expired, but not much. I mean, we're on track for 2024, which not all the data has come in yet, which is why it's projected. But for 2024 to see 75,000 completed foreclosure auctions. So we are well below, again, that basically a third of what we were experiencing in 2019. What we're forecasting for 2025 is 3 scenarios. If the market continues to be as strong as it has in terms of home price appreciation and low unemployment, which translates into low seriously delinquent rates, we're actually projecting that we would see that 75,000 in 24 go down to 69,000 in 25. Now, if you see home prices stay the same, but you see delinquency rates creep up, which we're starting to see evidence of that, we would expect to see 85,000 completed foreclosure auctions in 2025. And then if you had the delinquencies check up, but then also this pressure on home prices result in home price appreciation going down to almost flat for 2025, we would see that those completed foreclosure auctions go up to 99,000, which again, even 99,000, it's a fairly big increase from 24, but it's still half of what we were seeing in 2025. So the market, it's not like that I don't believe would have any type of substantial ripple effect on the retail market. Like, in 2010, when you had 1 million of those happening, that's one in every 4, 1 in every 5 sales that's happening out there. 99,000 out of 4 to 5 million sales is not going to drastically pull down the market. I think the market can absorb those, and in fact, almost welcome those because they represent lower priced inventory out there in the market.
Is there any data that says the houses that are listed, what percentage of them might involve a delinquent mortgage?
That's a great question. I've looked at this recently, and it was only about, the delinquency data is not public, so I can't do that on a address level. So I looked at what percentage of MLS listings have started foreclosure. So that's a much smaller number, but that was about 2%. So out of, if you have 5 million sales, or, it's more like 4 million right now, right? 4 million sales, 2% of that, what is that? Should be able to do that. Maybe 80,000, I believe, if I'm doing the math right, about 80,000. But 2%. And now if you expand that to delinquencies, I would guess it would be more like between 5 and 10%.
I was wondering if it was even higher than that because, really, if you look at it, the loans that are in foreclosure are just slightly over 10% of all the loans that are at some facet of delinquency, right? 2.2 million and 250,000 loans, it's less than 15% of all the delinquent loans are classified in foreclosure. So if you thought about it like, okay, well, a bigger percentage of loans, particularly those million loans that we've kind of been hinting around that no man's land, we refer to it as, right? I just wondered how many of those houses are getting listed. or with that are within that listing, and particularly increase in listings as we've been talking about?
Yeah, I would love to know that too. I haven't had to been able to put my finger on that because of that delinquency data not being record level. But I think, I think the low end of the spectrum would be 5 to 10% of the market, which starts, becoming fairly, it's not, dominating the market, but it's becoming a part of the market that's possibly could be driving some of the trends that we're seeing.
Well, Darren, I'm going to say that for me, I'm going to say that you're not pessimistic or optimistic. You're just being realistic, right?
I hope so. Yeah. Some people have called me a Debbie Downer in the past, and
all of us that are trying to make a living doing this, we just want to have a realistic perspective of the market. I guess if we're saying that that market's going to be flat and maybe have a little dip in it, that's being pessimistic. But the reality is that's been called for the last couple of years, and it didn't happen.
Yeah.
And so I'm thinking just more globally and not so marred down in all the data, but it's that we're kind of due for it, right? We're selling we've maxed out in the affordability level seemingly, and something's got to give.
Yeah, I totally agree with that. But it's all about the timing. I think there are underlying risks, and those risks are becoming bigger. The longer the market kind of almost ignores those risks, in a sense, the bigger those risks are becoming. And so it's just about timing, like when will those actually emerge and impact the market. We don't believe in a substantial way they're going to emerge in 2025 or materialize in 2025, but it's more of a matter of when, not if.
Got it. What else, Darren?
I think that's all. I mean, there's lots of other stuff I could talk about in here, but I think we've hit the main points that I get asked about. I know when I was talking to Joe earlier, we're talking about mortgage rates, and I do think the mortgage rates in context are not really high in the historical context.
Yeah.
And I think buyers and sellers out there are becoming accustomed to this, like they're going to be higher for longer, and the market will adjust to that. We even see our buyers were very sensitive to the mortgage rate jump back in 2022, but they've become less sensitive now and are adjusting their business to that. And I think you'll see that ripple out through the market as well. We've
just been in the industry norm, haven't we? Over the past 50 years, we've just been in the industry norm. I mean, it's about 7.5%, and over a long period of time, that's just what the data tells us, right? So we got used to oddly low rates, and nobody wants to face the news that that's not reality, but
yeah. You adjust. I mean, part that's another piece that's going to continue to put pressure on prices. But it may mean some sellers out there having to adjust their prices downward, right, to accommodate those higher mortgage rates.
Well, we are very grateful. This information is invaluable. We knew we would run a little long today, and we planned on that. So you shared an hour's worth of incredible information with us. And I will tell you this, that it is something that I personally, in running businesses related to these values and related to market trends, I place a significant value on the information you provide and helping me make decisions. And I'm grateful to you and your company for that. And I bet you we got a whole lot of people in the audience that say the same thing. So you're awesome. Joe, you want to finish us out here, sir?
Thanks for the kind words, Eddie. I appreciate
it. Absolutely. So this was definitely one where, you know, I've been leaning in the whole time. Darren, one of the things that kind of struck me, I mean, everything, you know, was so relevant, and it kind of, what Eddie and I have been saying on this show for the last several, you know, for all of 2024 is kind of coming to roost, right? But the the debt to income ratios being higher than 2006, that's a little bit. We know what happened year to 2 years later, right?
Yeah.
I'm just saying.
It's not. Yeah, I think we're not trying to call for anything like that.
No, we're not. No.
Darren, certainly not. Right.
No.
I don't want to like spook anybody that we're trying to draw that correlation. Mm-hmm. But affordability is the shocker, as we've all noticed, and you just got the data to prove it, right?
Affordability, and then of course the insurance and so on as well. So, Darren, thanks so much, guys. This is one you're certainly going to want to watch and stop it and watch it again on our YouTube channel. So make sure and do that. Darren, thanks again. Eddie, thanks so much for leading this and going in the right way. And hey, we'll see you same time, same place next week. And Darren, we'll have to have Darren back mid-year to do kind of a mid-year checkup to see what's come true and what hasn't. So anyway, thanks so much, and we'll see you next time.